On Wednesday, the Federal Reserve made a significant decision to raise interest rates, and it's clear that this move has negative implications for the economy. The rate hike not only poses challenges to economic growth, but also increases the risk of a potential recession. During their press conference, the Federal Reserve hinted that they might further raise interest rates in the future. In this video, I'll provide you with the key highlights from their press conference. You'll get to see their responses to questions regarding the possibility of higher interest rates, their plans for the next meeting, their assessment of the recession risk, and their timeline for cutting interest rates. Alongside presenting the clips, I'll also share my insights and analysis on the matter. Also, I will make a detailed video on the Fed pivot soon in the next few days, so please subscribe. Let me tell you what went down at the Federal Reserve. They conducted a closed-door meeting where they made the decision to raise interest rates. Following that, they held a press conference, which was led by Jerome Powell, the chair of the Federal Reserve. The conference began with a few minutes of prepared remarks from Powell, which I'll summarize in about 30 seconds. During his opening statement, Powell mentioned that the labor market remains tight, credit conditions have tightened, and though inflation has decreased, it is still above its target of 2%. He emphasized that they will carefully analyze incoming data to determine if further interest rate increases are necessary. After the prepared remarks, the Q&A session commenced. One of the reporters asked if the Federal Reserve is considering more interest rate hikes, and, if so, when they might occur. Powell responded by stating that such a decision has not been finalized yet. He emphasized that they will evaluate the situation meeting by meeting and make assessments accordingly. I have a clip of this exchange that I'll show you to get a clear understanding.
Steve.
Mr. Chairman, thank you. You have, I think, a couple times in your opening remarks talked about this language in determining the extent of additional policy firming that may be appropriate. Should we take that to mean that additional hikes are likely on the way? And should we also believe that all future meetings, say September and November, are live, or are you in a every other meeting mode? Thank you.
So we haven't made a decision to go to every other meeting. It's not something we've looked at. We're going to be going meeting by meeting, and as we go into each meeting, we're going to be asking ourselves the same question. So we haven't made any decisions about any future meetings, including the pace at which we'd consider hiking. But we're going to be assessing the need for further tightening that may be appropriate. You read the language, to return inflation to 2% over time.
Now, let me share a video clip with you that expands on the first question. During this clip, Powell mentions that at their upcoming meeting on September 20th, the Federal Reserve may decide to raise interest rates if the economic situation demands it. However, if the data suggests otherwise, they won't proceed with the rate hike. The final decision will heavily rely on the economic data gathered between now and the next meeting. This data will encompass 2 additional jobs reports, 2 more inflation reports, and an ECI report. Take a look to get a better understanding.
I will also say, since we're talking about it, between now and the September meeting, we get 2 more job reports, 2 more CPI reports. I think we have an ECI report coming later this week, which is Employment Compensation Index, and lots of data on economic activity. All of that information is going to inform our decision as we go into that meeting. I would say it is certainly possible that we would raise funds again at the September meeting if the data warranted. And I would also say it's possible that we would choose to hold steady at that meeting. We're going to be making careful assessments, as I said, meeting by meeting.
In this video clip, the reporter raises a concern about the potential dangers of raising interest rates too high, essentially questioning if it's possible to go overboard. Powell acknowledges the risks involved in both scenarios. If interest rates are too low, it may fuel inflation, and if they are too high, it could harm the overall economy. However, Powell emphasizes that in their decision-making process, they rely on core inflation as their primary indicator. As core inflation remains elevated, Powell suggests that they may consider raising interest rates further if they deem it necessary. The main takeaway from this clip is that the Federal Reserve places more importance on core inflation when assessing their course of action compared to headline inflation.
Well, I mean, you've talked for many press conferences now about the harm created by inflation, how hard it is for people. So how much of that are we still seeing with inflation now down at 3?
So I guess I would put it this way. I'd say it this way. It's really a question of how do you balance the 2 risks, the risk of doing too much or doing too little. And, I would say that, we're coming to a place where there really are risks on both sides. It's hard to say exactly whether they're in balance or not, but as our stances become more restrictive and inflation moderates, we do increasingly face that risk. But we need to see that inflation is durably down that far. As you know, we think, and most economists think, that core inflation is actually a better signal of where headline inflation is going, because headline inflation is affected greatly by volatile energy and food prices. So we would want core inflation to be coming down, because that's what we think core is signaling where headline is going to go in the future. And core inflation is still pretty elevated. There's reason to think it can come down now, but it's still quite elevated. And so we think we need to stay on task, and we think we're going to need to certainly hold policy at a restricted levels for some time, and we need to be prepared to raise further if we think that's appropriate.
In this video clip, the reporter questions Powell about the frequency of interest rate increases. Specifically, they inquire if the Federal Reserve's plan is to raise interest rates at every other meeting. Powell's response indicates that they are indeed slowing down the pace of interest rate increases. However, he clarifies that this doesn't automatically mean they will follow a strict pattern of raising rates at every other meeting. Powell explains that they could potentially raise interest rates at 2 out of every 3 meetings, for example. He emphasizes that the decision-making process hinges on the incoming data, and they will base their actions accordingly.
Thank you. Colby Smith with the Financial Times. If September is in fact a live meeting, how does that square with the need for a more gradual tightening pace that you spoke of last month in explaining the rationale for holding the funds rate steady at the June meeting?
So a more gradual pace doesn't go immediately to every other meeting. It could be 2 out of 3 meetings, right? It just means if you're slowing down. The point really was to slow down the decision cycle as we get closer and closer to, we think, our destination. And I wouldn't want to go automatically to every other meeting, because I just don't think I think it's not an environment where we want to provide a lot of forward guidance. There's a lot of uncertainty out there. We just want to keep moving at what we think is the right pace. And I do think it makes all the sense in the world to slow down as we now make these finally judged decisions. And so that's what we did. And so I think it's possible, I mentioned before, it's possible that we would move at consecutive meetings. We're not taking that off the table, or we might not. It's really going to depend on what the data tell us. That's the best we can do.
In the upcoming clip, the reporter raises a crucial question about how the Federal Reserve intends to address wage inflation without causing a recession. While Jerome Powell doesn't directly respond to the aspect of avoiding a recession, he does address the question regarding their approach to managing wage inflation. Powell's answer entails the Federal Reserve's strategy of cooling down the overall labor market. By doing so, the natural outcome is a reduction in wage growth. I'll let you watch the clip to see his response for yourself.
So wage inflation, like how do you target wage inflation without pushing an economy into a recession?
I don't think we're targeting wage inflation. I think what we're looking for is a broad cooling in labor market conditions, and that's what we're seeing. So wages have actually been gradually moving down. They're still at levels that would be consistent over a long period of time with 2% inflation. Nonetheless, we're making progress there, and by so many indicators, labor market demand is cooling.
In the following video clip, the reporter inquires about the timeline for the Federal Reserve to begin reducing interest rates. Jerome Powell responds by stating that he does not foresee it happening this year, and it's more likely to occur next year. However, he emphasizes that the ultimate decision will be contingent on how inflation is behaving. The Federal Reserve aims to ensure that inflation is on a stable trajectory, or the target rate of 2%, before considering any interest rate cuts. Please watch the clip to get Powell's full response.
So if it's sort of stubbornly in maybe the high 2s, you wouldn't necessarily cut rates?
I'm not saying that at all. I'm not giving you any numerical guidance around that. I'm saying we'd be comfortable cutting rates when we're comfortable cutting rates, and that won't be this year, I don't think. It would be, many people wrote down rate cuts for next year. I think the median was several for next year, and that's just going to be a judgment that we have to make then, a full year from now, and it'll be about how confident we are that inflation is in fact coming down to our 2% goal.
In this final clip, a reporter raises a question about the Federal Reserve's perspective on the likelihood of triggering a recession. Jerome Powell responds by expressing his belief in the possibility of a soft landing. He asserts that they can achieve the target of 2% inflation without experiencing a substantial increase in unemployment or a severe recession. Powell's remarks imply that they expect to reach the 2% inflation goal through a gentle economic slowdown or a mild recession. Please watch the clip to hear Powell's response in full detail.
A good part of Wall Street has become more confident that the Fed is going to be able to engineer a soft landing, and they've reduced their forecast for recession. And I'm wondering if the staff has changed its view on the likelihood of recession being likely, and if you personally have changed your view in terms of becoming more confident that you can achieve a soft landing.
So it has been my view consistently that we do have a shot, and my base case is that we will be able to achieve inflation moving back down to our target without the kind of really significant downturn that results in high levels of job losses that we've seen in some past instances, many past instances of tightening that look like ours. That's been my view. That's still my view.
I hope I gave you all the important bits from the meeting. Please let me know your opinion and please subscribe. Thanks for watching. Until next time.